All right, everyone, welcome to another episode of Portfolio Talks, where we're bringing the conversations around money right to you at your fingertips. This is a show where you're going to learn about money. Before you watch this episode, you might think, I don't understand this. Think about finance, it's not in plain English. After the show, our hope is that, at least with the concepts and the topics we're talking about, it'll make a lot more sense to you in a short amount of time. So, as always, unfortunately, you're stuck with me. My name is Vishal. You have Tyson. We're both from Portfolio Planning. And you have a special guest, Kalynka, here from the HomeHappy team. She is stepping in for Mike. Mike is probably on a winery, day drunk somewhere in the freezing cold weather, so a little bit concerned for him,
Probably.
but probably. But Kalynka's here stepping in, and we have some exciting topics. We want to talk to those of you watching this that have children and you're wondering, how do I teach my kids about money? We're going to talk to you about that. And then also those of you that have multi-generational families. So maybe you're the parent and you want to help your kid, or there's a grandparent, a parent, and grandkids, or anywhere in that kind of area, and you want to understand, you hear about intergenerational transfer of wealth. What the heck does that mean? And what can I do to be involved in that? So why don't we jump right into it? And Kalinka, from the mortgage standpoint, actually, let's pause it. Let's talk about kids first. So you both have children, and what does that look like when it comes to teaching your kids about money? What's worked, what hasn't worked? So, Kalinka, why don't we start off with you?
Yeah, sure. I think it's very interesting, and I'm sure Tyson relates to this as well. But once you become a parent, even before the child arrives, there is a button in your head that clicks, and you start to think about it differently, right? So you start watching yourself, your habits, and especially finances. So once we became parents, it's like, are we doing money right? Our actions, our habits with money, right? Because now we have a little one that's joining us, and if we're not doing it right, how can we teach him? So I feel like throughout, especially the first couple years, we really watch their finances, because one thing that reflects on kids a lot, and a lot of people don't know, is your habits on how you spend money, how you save money, how you eventually take care of your finances. Your kids are watching, they're little sponges. So even though they're not dealing with money, or sometimes not even holding money, they're watching and they see everything, and so it reflects on them, right? So I think taking a step back and really watching how you're taking care of your finances, essentially, your kids will learn. But sitting down, now that my little one can speak and he can understand us and he can have a conversation, he's 4 years old, we can speak about money and finances. And so what can you do with money? Where do you put your money? We have a little saving jar and a spending jar and contributing jar where he donates, and we choose with him where he wants to donate his money. And so teaching them since the very early, even with coins or paper money, call it whatever, is really important to them to learn these stages, and then of course later on in life develop them as they grow up with bank accounts or whatever. But it shouldn't be a late subject in line. We don't learn this in school. I wish we did, but the sooner you start, the easier it is for them to learn. Like I said, they're little sponges. So even with saving jars, they will learn from such early age that they will continue to grow those habits in life. Does that make sense?
Absolutely. I think
100%.
I'm glad to know that piggy banks are still a thing. I thought that was just a us
Yeah,
generation thing, but I didn't
totally.
know they're still around.
It's the easiest way to teach them, right? So he goes around the house and he finds coins, and then he goes and distributes them, and we tag the little jars, right? So it's a fun way to teach them. And another thing too, and this follows into sort of another rabbit hole, but it's energy. And so, there should be a positive connotation or meaning around money as well. A lot of people, money is dirty, don't touch coins, don't touch the money, or and so the kids grow up with that mentality, and it's really hard later on to teach them to reverse that, in a sense, when that comes from the parents, when that comes from inside the house. So having as much more conversation as you can, and having that positive attitude towards money, and teach them from the very early stages, is one of the best things you could do. Looking back at my childhood, I wish my parents did that. They didn't know. Today they do, but back then, I'm sure maybe even your parents didn't know about it or how to teach us. And it's one of the best thing you can do for your kids. That's how we see it at such an early stage.
You're 100%
Love
right
it.
on so much of that. And some of the conversations that we have with our clients is they want to change the fruits, but we have to change the roots of the
Mm-hmm.
family tree. There might be money trauma, there
100%.
might be bad money thoughts. If you have a baby boomer in the family that has lingering trauma from a depression in 1945, 1946, we have to understand that, but we also have to deal with that. And so we see a lot of these
Totally.
like multi-generational money beliefs that transition that nobody identifies, nobody wants to talk about it because it's uncomfortable. And
Yeah.
sometimes we have to undo those things or at least recognize them for the next generation to build their own value system. But you're 100% right on a lot of things. Is certain generations don't like to talk about money in the household because the old way was you don't talk about money because maybe
Mm-hmm.
there wasn't any, maybe there was a lot of expenses. Who knows what their situation
Yeah.
is? But it's very very common that they didn't talk about money. So we encourage families talk about money in a positive
Totally.
way and in a realistic way, right? You don't have to tell them about the stress of your bills because that's what most kids hear, right? Oh, like my mortgage like skyrocketed when interest rates went up. Interest rates just got cut today a little bit. Um, yeah, right. But talking about the positive things and learning about what you're going to do with the money. And I think that's part of the conversations that we have with clients when we're talking about the effects of what you want to do is talking about the goal that you're trying to achieve with money versus we have a very consumerism society right now where it's like
Mm-hmm.
I need to buy these new shoes. I need to buy this new thing. I need all my friends are going on vacation, so I'm going to go on vacation. And they use money to do things, which is good, but they create this habit of getting rid of money. And the multi-generational aspect of that is, unfortunately, we do see clients that receive an inheritance from their parents or their grandparents that pass away, and they have these value systems of getting rid of money and they spend through their whole inheritance in a year or two or three, and that could have set them up for a lifetime had we done the right things. But again,
Mm-hmm.
we're trying to change the fruits, and we haven't addressed the roots yet. And so those are some of the things that we see regularly.
Love it. Before we go to the next question, Kalynka, have you pre-approved your 4-year-old?
No, what do you mean?
Pre-approved for the
No.
mortgage. Get them through. Like, all right, we
No.
got a ton of money habits.
Yeah. Although there are things that you can do very early on for your kid to grow their credit. So you don't have to wait until they're 18 to find out that they have no credit or 19, right? So there are for sure early things that you can do to start growing that little one's credit, even though before they are pre-approved for a home. But yeah.
Why don't we
Um,
start there and then we'll segue into how to actually transfer wealth across generations. So why don't we just start off because that's interesting. What can they do if you have
totally.
a little one?
So yeah, so let's pick a credit card for example. You can put them as a beneficiary or as a second user on the credit card below you. So even though they're under 18, they can have their name on that credit card. And so of course you set a ceiling for how much they can spend or whatever that might be, and that way they can already start utilizing or taking advantage of building their credit. So, like I said, essentially, when they go, get pre-approved or have their very first credit card or whatever that may be, they might have a higher ceiling because they have already built their credit. It's just a first step into the game early instead of just waiting and having a hard time once that time comes on and they did nothing or the parents didn't really do anything to set them up.
Amazing. Really cool tip. So let's segue off of that and let's talk about intergenerational wealth. So this is a conversation that comes up all the time. People have either grandparents who have had a lot of their assets just appreciate, and we call them accidental wealth creators, where they just bought something, it just unsophisticatedly went up, and like, oh, sweet, I'm rich now, that's great. But they're asset rich. So they have these assets. Maybe the parents have it and they want to transfer to the kids, or the grandparents to the grandkids. So let's kind of have a conversation about that. I would love to dive into like mortgages. How do people utilize their homes to help the next generation? Tyson, I know we have some really cool things that we do with insurance and investments and things of that type. FHSAs are cool ones. And I think I'll start off by just letting you know how assets or investment accounts will work. So if you are a parent and you have, let's say, a pension, an RSP, TFSA, your money's in these accounts. Some people, more times than not, just assume that everything that I've accumulated in my lifetime will go to my kids. That is not the case. The government will come in first. So when things move from one spouse to another spouse, you have something called a spousal rollover, which is fine. And that's probably where the misconception comes from, is because you think that, hey, it went from this person to this person and there was never any tax triggered. It's because it's a rollover or a deferral. So if both people have an RSP, husband passes away, his RSP will roll over to his wife, and now that's been rolled over, and the tax bill isn't going to be due until she passes away, and it goes to the next generation. So a good way to think about it is if the money stays within the spouses, you're fine, it's going to defer the tax. But if that money goes up a generation or down a generation, you're going to trigger tax, and the CRA is going to come knocking and say, I want my cut. So what happens is with your RRSPs or your registered accounts, they get deregistered, meaning that they are no longer registered accounts. So they can be deregistered. Your RSP would be added to income on your last tax return, or we call it your terminal tax return. There's going to be other assets that can be passed over to your children, like a RIF account, but they have to be deaccumulated in the years while they are a minor. Unless you're going to school, you have a little bit more flexibility, but you only have a certain amount of years to pull that money out. There's nuances with all this stuff, like what if my child is disabled? Do they have more options? Yes. What if my kids go to school? Do they have more years? Yes. But the important thing to remember is that tax bill is always going to be due. So you need to plan around that and just understand and know that all of your wealth does not go to the next generation. It is going to be triggering tax before it gets into their hands. And then the question is that enough to sufficiently provide them with what you wanted? Is that what you wanted for them? Do they have enough cash to pay the tax bill that's going to be due? All those stuff are real problems, and there are solutions to them. So I just want to give you doom and gloom. Here's a problem. Tyson, I'll pass off to you first. What are some more efficient ways? You can be the good cop, I'll be the bad cop. But what are some more efficient ways people and clients of ours have been able to transfer wealth across generations?
Yeah, absolutely. Just toss me the grenade, and I'll deal with it. So, if we're talking about planning in retirement, you have some strategies. If we're talking about planning for end of life or estate planning, you have different tactics and stuff that we can use. So let's look at just the estate part right now, and let's talk about in estate planning wise, the transfer of wealth. There's a couple of things that you can do. Number one is make sure that you work with your financial team and you do estate planning, because what it's going to do is it's going to predict the amount of tax that your estate is going to pay. Most people's eyes pop out of their head when they understand that the moment you pass away, you do get that large tax bill that Vishal referenced. And for a lot of people, it is their highest income earning year because you convert all your registered assets into cash, and it counts as income for most of our clients. And so then they look at it and go, man, that they don't get a trophy for like the greatest year ever for how much income they earned. But the tax man looks at it that way. So we can look at it, and there's situations where let's say we look at a client, they've done very, very well for themselves. We do their estate planning, they're gonna have a $2 million bill come tax time on the terminal taxes. Is we can do something about it before that actually happens, and that's some pre-planning stuff. And some of the things that we've done is we've used charity to offset taxes and then actually replenish the family through life insurance. And you could do that on a cash flow neutral basis even. So we can use that money and not have it really cost the family anything and make them whole, and the taxman still gets their cut. But the estate is actually totally intact when it transfers and hands off to the next generation. There are also some things that you can do while you're alive in terms of like pre-inheriting some of your beneficiaries and gifting the money down while you're alive, and also gifting stuff. Just imagine dealing with an estate and you have a library, or you have a spoon collection, or you have a grand piano, or you have all these things, and the next generation is going to fight over them. But if you pre-inherit all of that stuff and you designate like, hey, this is the family grand piano. It's been in our family for 100 years, and I know the next generation, there's only one person that plays the piano, so we want to make sure that they get it. You pre-gift it to them now, and then they write you a legal note back saying they're loaning it to you. And so that has already been established, and then you don't have to go to court over who's going to get the family heirlooms. Those are some strategies that we could do. We've also seen in some cases where with your registered accounts, if they're really large and you're not going to need all that cash, maybe we should de-accumulate your registered accounts now. We'll figure out how to deal with the tax. There are tax advantage strategies to do that. And then you can reinvest that either as a non-registered or utilize your tax-free savings account. Most Canadians, especially seniors, they don't understand that you can use a tax-free savings account to invest money. You won't pay tax, and then you can transfer that to a named beneficiary after your passing, and they won't pay tax. They won't get the tax-free savings room, but they won't pay tax. There's a lot of mechanisms and strategies that we can utilize to build a plan to transfer that wealth. One of the ones Vishal and I were talking about that does impact the HomeHappy team is talking to grandparents about funding their grandchildren's FHSA accounts. The idea was the grandparents would give the money to the grandchildren who are adults, and they fund $8,000 a year into their FHSA. They don't have a beneficiary designation on FHSA accounts yet, but the strategy that was put out was you would name the grandparents as the irrevocable beneficiary on the FHSA account, and that way it becomes a two-to-sign account. The grandchildren can't spend the FHSA on the new release of Jordans or anything that's going to come out and blow through their inheritance. It is designated for buying their first home, and that's something that we see really starting to happen. It takes a couple of years for these new programs to gain traction. Like the TFSA, people were still asking what it was in 2013 and 2014, and it had been out since 2009. And so FHSA is only 2 years old, and people are still learning that we have this option, and then they're trying to learn how to use it.
Those are wicked. The only other strategy that I would also add on is one that we've seen for our clients that want a simple way to transfer the wealth, and they've been here for a couple generations. What we've seen a lot is the grandparents want to transfer money to their grandkids. Instead of buying toys and stuff like that, although they always do, what they do instead is they would fund a life insurance policy on the children. So we've seen it set up mostly for like a 10-year or a 20-year payment period. So the kid is 0 years old, they're just brand new and born, and the grandparents will want to spend $10,000 a year, for example. Perhaps it's $5,000 on each side of the family. So in general, it's going to be $10,000 a year on these life insurance payments, and they pay that for 10 years or 20 years. And now that child has a fully paid up permanent life insurance policy that increases over time, and it has a cash value portion of that insurance policy. We just did one for a client who put $10,000 a year, so grandparents pay $10,000 a year into this plan. They're gonna do it for 10 years and they're done with it. By the time the child turns 65, they're gonna have $140,000 a year in dividends that are gonna be a fantastic retirement. So maybe that's the entirety of their retirement, maybe that's a big portion of it, or maybe they don't even need it and they can do the wealth transfer strategy again to the next generation. So it's a really cool way that you can start to transfer wealth down generations, and it costs the grandparents $10,000 a year for 10 years. By the time the kid is 10, they have this inheritance that's going to last them a lifetime. So that's a really cool and simple way to transfer wealth as well. So we want to wrap off with talking about mortgages, because that is a hot topic. Interest rates are down, so it's going to be even more of a topic. But what if the grandparents or the parents have real estate and they want to help their children eventually buy real estate? Tyson talked about the FHSA. What do you see, Kalynka, on the mortgage broker side of people using their homes to help the next generation buy homes?
Yeah, of course. And it's a topic that we're trying to educate more and more grandparents or even parents, because sometimes they do want to help and they just don't know how. So one thing, if your kids are struggling, you really want to help, but you don't have the cash flow, or you're house rich and money poor, in a sense, you can actually take some equity out of your home. Maybe you have a place and it's worth really good money. You have a good market value on the property. You can take equity out of the house. So that means you'll refinance that home, take the equity out, and allow your kids to have money for the down payment, right? So essentially gifting your kids sooner than waiting until, something happens. And as we know, it's not an automatic transfer. So there are ways where we can refinance the home and essentially help your kids with the down payment. That's one of the solutions where we can see that grandparents can help, or even parents, to allow their kids to have a place sooner. A lot of times, a young family in Canada trying to save money for their down payment, inflation as it is, or, country in recession, call it whatever, a bit of chaos that's going on. It takes them quite a bit of time, as we know, to save up for that down payment, especially if they're not as well financially educated. So we're trying to open the eyes of the grandparents and bringing them solutions. Hey, there are ways for you to gift your kids, and help them with the down payment. So that's one way that we can do it. For whoever is curious, the best way to start is a conversation, right? There's a lot of questions around how can I qualify, my income, this and that. There are different ways, and lender will look at everybody different. One thing that me and Mike always say is, or the HomeHappy team, everyone's situation is different, every scenario is different, and so it's not one size fits all. We look at everyone a little bit different. We want to hear your story, how much you want to help with, and then based on all of those pieces that fit together, find the perfect plan that works for the grandparents, the parents, and the kids. But essentially, starting a conversation is the best point for them to find out more, and for us to help them with the best solution.
Really well said. So hopefully if you watch this, you got to understand a lot of different opportunities or options that are out there. Which one is right for you? We don't know. To Kalynka's point, it really starts with a conversation, because we don't know your history. It's the same as if you walk into a doctor's office and you're like, I need a prescription. They're like, for what? Like, I don't understand what your problem is. It's the same thing for us. So we need to understand your financial history before we can prescribe the right recommendation is going to be. So as always, we're here to answer questions. The whole point of portfolio planning is to translate finance talk into plain English for you all, share some strategies, help you improve your knowledge, and then, if you need to figure out what makes the most sense for you, you can reach out or ask questions below on whatever platform you're watching. So with that being said, Kalynka, thank you for joining us. Tyson, myself will be here each and every week, and hopefully Kalynka's here more often than not, because you dropped some amazing knowledge, and I'm really just blown away that the piggy banks are still around, so I'm really excited about that. But any questions you guys have, feel free to ask away, and as always, if this gave you value, please like, subscribe, share. It just gives us good confirmation that this is stuff that you want to see. And if it benefited you, why would you not want it to benefit your friends and family around you? So see you guys next week.
Thank you for having us. Bye-bye.